All right, let's get right into it and break down the mechanical realities of price delivery. If you've ever felt like the market is literally just hunting your stop losses, trust me, you are definitely not alone. Today, we're unpacking the absolute core concepts behind market bias. We're going to logically group everything you need to know, building out a complete mental glossary so you can confidently determine market direction without constantly getting stopped out.
We've got a packed syllabus today. We'll be hitting the 2 price pillars, the 4 conditions of price, the time frame puzzle, the mirror concept, trade execution strategies, and capping it off with a live market application.
Section 1. The 2 price pillars. Understanding exactly where price moves.
Let's kick things off with a foundational reality. Price only ever moves between 2 specific points. First up is the point of interest, or POI. This is simply an area where price is about to move from. It's your starting block. But here's the trap a lot of beginners fall into. They fixate entirely on finding this area, endlessly marking up their charts, while completely ignoring the actual destination.
And that destination? That's liquidity. This is the exact level that price targets and moves towards after leaving a POI. Honestly, liquidity is just as crucial. It is the ultimate target the market is hunting for. If you're only mapping your POIs and totally ignoring liquidity, you're basically only seeing half the board.
So what do these POIs actually look like in the wild? Well, first is the order block. This is a specific type of POI that price taps into to initiate a movement. You see, once price grabs that liquidity we just talked about, it will very often seek out an order block to reverse and kick off its next big explosive move. Next in our glossary, we have the FVG, or fair value gap, and the BPR, which stands for balanced price range. When these combine with order blocks, you get a highly fortified, massive area of interest. And a quick tip, you'll actually often find these balanced price ranges nested right inside these areas on your lower timeframes. Finally, wrapping up our POI types, we have mitigation and breaker blocks. These specific POIs form when price breaks or closes past a certain level. Think of them as defensive stepping stones. The market uses them to push price relentlessly towards its final liquidity target. A great way to visualize all of this is through a really simple analogy. Think of price as a lion leaving its cave. The cave is your POI. The lion goes out to hunt a deer, which represents our liquidity. Now, once that lion feeds, it doesn't just run around aimlessly, right? It either returns to the cave or it rests and hunts another nearby deer. Price works the exact same way. It goes from a POI to liquidity and back to a POI. Section 2. 4 conditions of price. Categorizing every possible market movement.
Now that we've got our definitions down, let's categorize the 4 exact conditions the market can possibly be in. First, let's contrast main bias with reversal bias. Main bias, or the trend, is when price moves from a POI to hunt liquidity. This is your absolute high probability setup. Reversal bias, on the other hand, is a counter trade. It's price moving from liquidity back to a POI. This is way riskier because, well, you're trading directly against the overarching momentum.
And alongside trend and reversal, we have 2 types of consolidations to look out for. Big range consolidation happens when price just bounces from POI to POI within a really wide range. Then you have small range consolidation, which is when price violently hunts back-to-back liquidity on both sides of a tight, choppy range. Honestly, as a trader, you usually want to avoid both of these entirely.
Section 3. The time frame puzzle. Why your lower time frame trades fail.
Let's solve a massive frustration right now. Why do your 1-hour POIs constantly get smashed, stopping you out of seemingly perfect trades? Well, it all comes down to perspective. Imagine you're standing inside a maze. If you're stuck exclusively on the 5-minute chart, you are zoomed way too far into that maze. All you can see are the walls right in front of you. You're completely blinded to the true overarching path of the market. You absolutely have to look at the higher time frames to find the exit.
So, the crucial takeaway here is the strict top-down hierarchy. The monthly time frame dictates your primary direction. The weekly sets the boundaries. The daily highlights the major POIs. And the 1 hour, that is your absolute minimum time frame for entries. Lower time frame POIs simply do not have the strength to stop a monthly liquidity hunt, period. You must verify everything from the top down.
Section 4. The mirror concept. Holding winning trades with confidence.
So how do you logically hold these trades without completely panicking during a pullback? You know that feeling when it looks like price is reversing just to take out your stop loss? This is where the mirror concept comes in. The idea is that defensive POIs act like literal mirrors to reflect price back into the trend's direction. Just like a physical mirror reflects light, newly formed order blocks and FVGs that appear while your trade is moving will catch those retracements and bounce price right back toward your target. Understanding this is what gives you the psychological armor to hold through those scary pullbacks.
Section 5, Trade Execution Strategies, Microscopic Tactics for Entry.
With our macro direction locked in and our mindset fortified, let's funnel down into the microscopic, actionable execution tactics to actually secure your entry. A really reliable entry model here is the 4-candle strategy. It requires 4 exact steps. First, price must tap a POI. Second, the very next candle must show strong displacement, meaning a powerful, aggressive move away. Third, price will briefly retest the area. And fourth, it expands and hunts that final liquidity. And hey, remember, if there is no displacement, the POI is completely invalid. Scratch the trade.
Next up in our execution glossary is the MSS, or Market Structure Shift. This is a break in the current price structure that absolutely must occur on lower time frames before you safely enter a trade. Please never jump in blindly just because price touched a daily level. You have to wait for an MSS on your 1-hour chart to confirm that the higher time frame POI is actually holding.
You'll also want to look for the optimal trade entry, or OTE. When you're drawing your OTE tool from the swing low to the swing high, you're aiming to enter precisely at the 0.5 or 0.6 levels. These spots offer the absolute best risk-to-reward ratio. And as for your target, set your take profit right at that -1 level.
Finally, we have to talk about session timing, because when you trade matters just as much as price itself. The Asian session is generally where initial liquidity is built up and hunted. Then, the London session is where the true trend really begins to develop. And the New York session? That's known for those fast, explosive market expansions. That's usually where you'll find those perfect OTE entries we just talked about.
Section 6, Live Market Application, applying the top-down methodology to gold.
Let's put this entire puzzle together and see how these exact concepts apply to a live top-down analysis of gold. First, we use key level proximity, which is the rule that price always targets the nearest key level first. Because of this, the gold monthly chart hunted nearby liquidity rather than reaching for distant POIs. That hunt caused a drop straight down into a daily order block. Now, sitting at that daily order block, we don't just blindly hit buy. No way. We drop down to the 1-hour chart and patiently wait for our market structure shift before we even think about executing our entry.
We've just systematically built out a comprehensive glossary and broken down the complete mechanics of market bias, from the exact relationship between POIs and liquidity to the strict rules of time frame hierarchy, all the way to the psychological armor of the mirror concept. So now that you have the full playbook in your hands, are you still trying to solve the trading puzzle from the inside? Or are you ready to finally zoom out and trade like a lion?